Let's go back and think about papers 3 and 4. Um, what we're trying to accomplish. So it's all in this Excel spreadsheet. I'm still thinking about whether I put this out there. I don't want. My concern is somewhat what I saw with exam 1 is there's way too much copying and pasting. I want students to do their own work. In finance, you have to be independent. You have to be able to think for yourself, write your own stuff, do your own analysis, and if I give students the temptations to copy and paste, that's what a lot of them do, just because it's the easiest way to do it. But boy, it sure doesn't help their career. It sure doesn't help their learning. So we'll see whether I put this out there. I'd much rather you watch the video and come up with your own way of saying it, your own opinion. Your opinion might be weak right now, maybe because you're not. This is your first time to see this. You really don't know exactly what you believe. Put something down and go with it, and give yourself a chance to start experimenting with what your beliefs are and what you think, and put things down. I much prefer students say something that would be considered pretty radical and pretty way out there in finance than just copy convention and do the safe route. So it's, what do you actually believe? Stop and think. Rather, don't think, wow, what does this professor want for this paper? Because you're not going to be doing that in your career. You're not going to be thinking, man, what does my boss want me to do? You do that, you will not do well in finance. Your boss hired you for independent thinking, being willing to take some chances and do some analysis that might be a little risky, just to start learning and putting your own stamp onto what your work is. But in this project, we are going to follow somewhat convention and using capital asset pricing model. So paper 3, you need to come up with a risk-free rate. So again, what do we talk about there? Well, do you just use the current 10-year treasury, or are you going to somehow adjust it? My approach was to use the bootstrapping method. I'm hoping not 100% of students will do that and just copy my approach, or at least try some other bootstrapping than I did. I did the 10-year treasury versus the 20-year treasury. There are other approaches you can use, but I like this approach. It did not give us a very high number. We rounded up to 1.5%. But the current 10-year treasury is so low. We did the market risk premium. The market risk premium, I'm saying use the implied approach. So I do want you to use the implied approach. There are other approaches that you can use, but the implied approach is the dominant approach. So it's very good for your career to just do that approach. But there are some adjustments you can make to it. I would encourage you to have different assumptions than I have here. Don't just copy my assumptions. I really don't want to be reading, like I saw in the exam, reading my notes over and over again 61 times. That would be really boring and also not much of an education from your standpoint. There are some charts, though, that you can use in your papers. So this chart on where historical growth comes from in the economy is not a bad chart to put into that part of the paper. You then need to come up with your beta, and you need to go through the 4 steps. So here I am telling you, use these 4 steps. You go through the 4 steps. You do need to create the beta chart for your company. So I do want you to do that. There are some things I want you to do just because I want you exposed to them. I do want you to use this chart that comes from that spreadsheet that shows you the firm's relative debt to equity and also shows you how volatile their margins are. I do want that. Again, if you want to ignore gross margin, that's fine. Some of your companies might not even have a gross margin, but definitely show the debt to equity and definitely show the net margin standard deviation as an indication of financial leverage and operating leverage. And then come up with your final beta. Remember, extremely important, that you don't just use step 4 to get your beta. A lot of students, that's all they do. They do steps 1, 2, and 3, and then when they get to step 4, they just ignore it. So make sure you're thinking through what is the right beta for your firm. I use a 0.65, and you can see last session I started thinking that maybe my base case should have been 0.7. So you might have to come back and reword this part of the paper and justify a 0.7. Since I was doing this without the chance to go back and rework it before I showed it to you, I probably would have, if I'd done it after the fact, come back and change that to 0.7. So there's paper 3. There's the steps. It's a few, 3 to 7 pages, depending on how many graphs and charts you use. It could be 20 pages easily. You saw that one article just on market risk premium that went on, for 20, 30 pages. You can talk a lot about this, but probably don't need to. Probably a few paragraphs on the risk-free rate, a few more paragraphs on the market risk premium, and then quite a bit of discussion on on beta. So one whole paragraph or so about revenue sensitivity. Operating leverage, you have this chart on the standard deviation of the net margin, but you also want to talk in terms of, what kind of demand do they have? Is this an industry that has elastic or inelastic demand, and what kind of cost structure they have? So there is a subjective discussion you can have here in addition to the chart. Then you get to paper 4, and the hardest part on paper 4 is coming up with the growth rates. Your long-term growth rate will probably be tied back to whatever your economic growth was for the market risk premium. You'll probably use the same number, or you might use something slightly lower, slightly higher. Even if you're doing alphabet, you're not going to be radically higher than that for long-term growth. You're not going to use 20, 25%. So if your economic growth is 5%, maybe your company grows 6, maybe it grows 4. It's unlikely to be radically off of those two numbers. Short-term growth, I gave you two approaches there. One is the PEG approach and the sustainable growth approach, but those are just inputs. You can notice that I kind of took the average of the two or something in between, but you don't even have to do that. You can throw one of them out and use the other. You can throw them both out. Say, I don't care what these two say. Here's my assumption, and as long as you justify it, write a paragraph or two on how you justified your short-term growth, that's fine. The H, you need to have a paragraph on your H. I just threw one out. You'll have to go back to the video of what I came up with Walmart. That's just your creative writing. What do you think? If you're doing alphabet, you think they're going to start at 25% growth rate, and over the next 20 years they're going to get down to a 6% growth rate, then explain how you got that 20 years. Like if you use 20 years and your H is 10. One thing I'll tell you is H's above 5 are pretty rare. Very few, especially for high growth. Very few firms can sustain a high growth for more than a decade. So a decade would be at H of 5, because remember the H is 1/2 of that period. Your inflation, whatever number you use for inflation up here on the market risk premium, I would use that same number for inflation here. No reason to reinvent that. You get your dividend 0 and earnings per share 0 from Yahoo Finance. Remember, on the dividend 0, you go to the history and you just add up the dividends from the last 12 months. Don't use the number actually on the summary page at Yahoo Finance. It is important here that for this to work, the company you pick needs to have dividends and needs to have positive earnings. There is an adjustment I can make. If you wanted to do an alphabet that doesn't pay dividends, there is an adjustment I can make. I can give you their free cash flow per share as a substitute for dividends. The problem with that is I don't have access to Bloomberg right now, so I don't actually have the ability to give that to you. Then at the very end, you put the numbers into the model. Double check your models. I have students that give me really bad numbers. Remember, if you get a negative number, remember this down here. If your KE is less than your long-term growth, you've got a problem. You either need to reduce your long-term growth or increase your beta to get a higher KE. If that's the case, you will get a negative number. Do not give me a negative number in your paper. That is an error, and I'd count off a lot for that. Remember, a negative number doesn't mean you think the stock's worth negative amount. A negative number means you think the stock is worth infinity. And so be careful on that. On all three models, it's unlikely to happen on the cap earnings model because you're using a much lower growth rate at 2%. Now, your short-term growth rate can be higher than your KE. That's fine. It's just your long-term growth rate cannot be greater than your KE. All right, so you're going to work through all of that. Maybe because of COVID-19 and all that, maybe I will put this file out there, but this should not be what your paper looks like. Your paper needs to look like a paper. Don't give me bullets and put it into paragraphs, make it look professional. I can really tell the students that are copying and pasting because their paper looks almost exactly what I just did here in Excel. So I want a professional looking paper. So let's look back at the paper description. Sorry, I keep messing up my documents here. So paper 3 and 4, discount rate, valuation of a stock. We'll talk about the due date. We'll get into as we get closer. Maybe I need to add a week for that, but it'd be better not to. That's a month away, and you have paper 2 due next week, so you have some time to work on it. I do have this video. These are very different videos than what I just created, so you're probably better off just watching the videos I did for the class and not watching these. If for some reason you want to see another example, you can go through these. They should be very, very similar. There are probably some differences in there, so I'd recommend not watching these videos, but instead watching, since we have the videos for the class now. So paper 3, you determine your discount rate. Select a company that is paying the dividends and has positive earnings. You need to have a section where you talk about the risk-free rate. I give you that Damodaran article to reference. You have a section of your paper talking about how you came up with the market risk premium. You'll be using the implied approach. So this says recommend using, I don't know why that went away, but the implied approach. I don't know how that got deleted, but use the implied approach, not the historical approach. There are other approaches, so some of y'all want to see the other approaches. I have a really good document from JP Morgan that shows some of the other approaches for coming up with market risk premium, but I'll assure you the most common approach is the implied approach. And then beta, we just talked about that, so you can make sure you have all of these steps. Each one of these needs to be a discussion. Don't just, the financial leverage is probably the easiest. If their debt to equity is higher than average, then that gives you a higher beta. If it's lower, then it gives you a lower beta. That's the easiest one, but the other ones should have some discussion. You do need to do your rolling beta chart. There's a video here on how to do it, and also the video from this class on how to do it. Be careful, this video here, I'm probably using weekly data and probably going back 3 years. I now use monthly data and go back 5 years so that you have a number closer to what Yahoo Finance is showing, so your last number can at least be checked. And then you put it all together, come up with your capital asset product and model, and make sure on beta you talk about all 4 of these things when you come up with your final answer. And in paper 4, you must use the Gordon growth, capitalized earnings, and the H model. You must use all approaches. You must justify your growth rate, your long-term growth rate, and your short-term growth rate. You don't have to justify KE in this paper. You already did that in the previous paper. You don't have to justify dividend. This is dividend 1, but we're actually using dividend 0 times growth. So, and we're using earnings per share 0 times 1 plus inflation. So dividend 0 times 1 plus growth, earnings per share 0 times 1 plus inflation. So use the formulas I used in the class files, but this is correct. Dividend 1 is dividend 0 times, so you're actually using this formula. You're actually using this second formula. And then the H model. Remember, on the capitalized earnings model, you need to explain it because it's my model. It's something only Professor Sweet knows about. If you use the term capitalized earnings model in an interview, they will not know what you're talking about. They'll definitely know the Gordon growth or the dividend discount model. They might know the H model, but I'm allowing you in this paper, you don't have to explain the H model because it is out there. It is a somewhat common tool, but the capitalized earnings, you need to add a paragraph to explain that. You can get that description out of the notes, just put it into your own words. So make sure you have a good justification, and then at the very end, don't forget this last part, is have a recommendation. You cannot do the recommendation without comparing your valuations from 2, 3, and 4 to the actual current stock price. So you need to do that as well. So that's part of this paper. So if you do that, you got your paper 4. Here's a student example on Valero. I guess as they're way off because Valero stock has dropped tremendously, but not the fault of the student for evaluation, but probably just completely unheard of with people driving so little right now. But I like this format. You have a good title and you have a good abstract saying what you're going to do in the paper. You give some background on the company, what they do. This is important when you get to the beta discussion, especially with the revenue sensitivity. What kind of business is it in? A little bit of discussion of capitalized CAPM. I'm not saying that's required because obviously your boss would be a little insulted if you had this in your paper, but it's not bad. A discussion on the risk-free rate. He decided to use the bootstrapping method, which is fine. A discussion on the market risk premium. You can see his discussions here. He made adjustment for buybacks. You don't need to do that. In my security analysis class, we do that. He decided to take that article and actually make that adjustment, but it does have a little bit of an impact. There's the chart that I showed you on GDP growth by decade. He used that, and he came up with his his market risk premium. Then his beta discussion, he talked about the revenue sensitivity of the firm. Operating leverage, you can see he has the gross and net margin. He cleaned them up a little bit, which is kind of nice. Financial leverage, he talked about that. Historical beta. And then he has a discussion. Some students actually have a table here where they bring all four things together, and he comes up with this debate and then his final recommendation. But he's going to do a sensitivity between 0.7 and 2.2. That's a very, very wide sensitivity, but if you do the data table, then you might discuss your range here. That gives him a discount rate, and then he does valuation. He looks at what their dividends are, comes up with the long-term growth. Here he's going to probably reference back to what he did at the first part of the paper, but also talking about the business. So you can see he has a fairly long discussion of long-term growth. Short-term growth, he used the PEG ratio, the sustainable growth approach. And then you can't do historical growth very well. You could if you wanted to go try to get all the numbers. They're probably out there somewhere, but that third approach without Bloomberg is a little tough. And then he came up with his final conclusion on the short-term growth. He had a short paragraph on H, which is fine. Most students get 0 credit for H because they don't do much discussion. You cannot say, and I hear some students say this, I think it will take 6 years to get from short-term growth to long-term growth, therefore my H is 3. That's not a discussion of H. Just to say that H is 3 because I think it's going to be 6 years. You have to explain, well, how did you come up with that 6 years? Then he does the Gordon growth model, the cap earnings model. He actually explains it just in a short paragraph what that is, and then he does the calculation. He does the H model, final valuation. Now, he had that range on the beta, but he never used it. So for some reason, he put that in there. That would have been good to have a data table here at the end. Your final valuation. He has the current stock price up here, and then his valuations. Either way, you can do it. If you do the data table, just some way to say what your final recommendation is. So his valuation ranged from $60 to $146. If I'm pretty sure it's that $60 might have been a good valuation if you just look at what's going on with Valero. I don't know how much it's fallen, but it's fallen a lot. So if you look at VLO on Yahoo Finance, yeah, it's at $50. It has fallen, oh man, how much in the last year? Pretty amazing. Let's go back 6 months and just see. So it's gone from, I don't want a comparison, I just want to see the stock price. So it was over $100 and it's dropped down to 50. It was even lower. Wow. So it has had a pretty good recovery here along with the rest of the stock market. So does that mean he made a mistake? The stock was trading at 90 and his worst case valuation was $60. Well, we weren't talking about COVID-19 and people stopping driving their cars entirely. So that, given what he knew, this was probably a decent valuation. But yeah, it is pretty amazing. A stock that was $90 when he did this paper at the end of December is now traded down below $35 just a few months later. So who knows? It doesn't mean you made a mistake. It's just there's a lot of uncertainty in these valuations. You don't have to be right 100% of the time. If your valuation models are better than average, you will do extremely well in finance. So there's the paper. You can see he covered it exactly in the framework I showed, but he brought a lot of extra stuff in. So I want you to follow the template, the different sections, but you have a lot of freedom within there to bring your own analysis in. You can see he definitely did that. All right, so that is papers 3 and 4. So you now have everything you need for the class other than just to get to the final exam. So we'll talk about 3 and 4 again after you finish paper 2. So hopefully you're ready to start on paper. You're almost done with paper 2 and get that done. You can start immediately on paper 3.